If there was one piece of advice that I'd give to a prospective client, it would be this: market timing can be hazardous to your wealth. Let me give you a simple example here, just taken from recent history. On average, over the last 20 years, the S&P 500 has gone up by about 9% a year. But if you look at the returns that real investors have gotten over that same period of time, they've achieved less than half of those returns. Why? Because folks tend to try to time the markets. On average, investors put about $25 billion of capital into the U.S. stock markets every quarter. But if you had looked at the top of the tech bubble, investors were putting in hundreds of billions of dollars a quarter. Of course, at exactly the wrong time, just before the markets fell. After the markets fell, investors took money out in 2001 and 2002, exactly the wrong time, the best time to be buying. And of course, over the more recent past, in the bubbles of 2004, 5, and 6, and then the crash of 08, we saw exactly the same behavior. So again, the guidance here is clear, although it's hard advice to take. You have to invest with your head and not with your heart.